on Twitter, somebody had retweeted or put out a tweet on what the going forward consensus Bloomberg gold prices were in the next 4 or 5 years. And they were trending from 2,400 back down to 2050, 2070. And I laughed because I thought that's just absurd. I mean, I think that gold is going to 3,000 and then it's going to 5,000 and then it's going to 10,000. So, and the reason I say that is that it's just so deeply undervalued compared to all the money that we've printed and created. And I think the world is beginning to realize that fiat currency is doomed. And as fiat currency is doomed, you want to purchase things which the government can't print. And in an analog form, gold and silver are the leaders in those two things.
Gold prices surged on Tuesday, breaking through the $2,400 barrier amid escalating geopolitical tensions in the Middle East and growing concerns over the United States' fiscal situation. The precious metals spot price, gold dollar, jumped more than 0.80% to trade at $2,404 during the North American session. The latest spike was triggered by news of Israel's attack on Lebanon, specifically targeting Hezbollah commanders in Beirut's southern suburbs, according to sources cited by Reuters. This development heightened market risk aversion, driving investors towards safe haven assets like gold. LawrenceLepard, founder and managing partner of Equity Management Associates, LLC, an investment firm specializing in monetary debasement strategies, has closely watched gold's recent performance. Lepard believes the metal's decisive break above its 2020 high of around $2,400 marks the beginning of a new upward trend. This surge in gold prices comes against a backdrop of mounting fiscal challenges in the United States. On Monday, the U.S. Treasury Department reported that the federal government's total public debt has surpassed $35 trillion for the first time. This staggering figure is equivalent to the combined economic output of China, Germany, Japan, India, and Britain. The nonpartisan Congressional Budget Office projects even more concerning figures for the future. They estimate that the public debt will reach over 106% of GDP by 2027, breaking a record set in 1946 during the post-World War II era. Beyond that, the debt-to-GDP ratio is expected to continue its upward trajectory in the coming decades. Lepard warns that excessive U.S. spending creates an unsustainable fiscal situation, potentially forcing the Federal Reserve to monetize debt through further printing money. He argues that this scenario is already being priced into rising gold markets as investors seek protection against potential currency devaluation. Please tune in for our exploration of Lawrence Lepard's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
So let's just start with gold and silver, or particularly gold. As we all know, it kind of broke out from a range it was in at 2070 as was the high. It's on the massive print associated with COVID, it squirted from the 1700s, 1600s up to 2000 and change, and it really has consolidated as Powell tried to be Paul Volcker, which he really can't be, but he tried by taking rates from 0 to 5.25. So we've been kind of stuck in this range since the top in 2020. We broke that top decisively, went up to 2,400. We're just below that right now. And I believe the next run is just in the process of beginning because it's becoming more and more evident that the U.S. fiscal situation is just massively out of control. We just crossed $35 trillion in debt. We're looking at, a $2 trillion deficit. We spent an enormous amount of money in COVID. And what's surprising to me, or not, I guess not, but the thing I think is most notable is that the spending went up by a couple $1 trillion in COVID, and it hasn't come back down. I mean, COVID is gone, and yet the spending is still there. So we've really got a massive problem. And as we were discussing before the show began, the United States is beginning to look like a banana republic or a third world country. I mean, we are basically spending way above our taxable income base, and therefore the Fed is going to have to monetize the difference. Now, they haven't been doing that recently because they are actually letting their balance sheet run off, although they reduced that a little bit earlier this year. And they haven't started cutting interest rates yet, although they've signaled that that's imminent. And I think what gold is doing is it's front running that. It knows, it smells what's coming, which is another big print, another round of enormous monetary debasement. And of course, silver is the same story, only it's turbocharged because it's a much smaller market and there's not a large existing stockpile of silver, and it's getting used up continually in some very rapidly growing industries, including solar. So while I love gold, I really love silver. I just think silver is going to run much harder and faster, which is the typical pattern in these precious metal bull markets. So what the going forward consensus Bloomberg gold prices were in the next 4 or 5 years, and they were trending from 2,400 back down to 2050, 2070. And I laughed because I thought that's just absurd. I mean, I think that gold is going to 3,000 and then it's going to 5,000 and then it's going to 10,000. So, and the reason I say that is that it's just so deeply undervalued compared to all the money that we've printed and created. And I think the world is beginning to realize that fiat currency is doomed. And as fiat currency is doomed, you want to purchase things which the government can't print. And in an analog form, gold and silver are the leaders in those two things.
Recent U.S. economic data has shown a moderation in inflation. The Commerce Department reported in June that price increases have slowed, particularly in goods, while services costs continue to rise modestly. This improving inflation environment has led some analysts to speculate that the Federal Reserve might consider interest rate cuts as soon as September. However, not all market observers share this optimistic view on inflation's trajectory. LawrenceLepard offers a contrasting perspective. Lepard predicts that we are on the cusp of a new inflationary cycle, drawing parallels to the economic patterns of the 1970s. Despite current inflation readings around 3%, Lepard anticipates a surge to approximately 12% in the next wave. He attributes this potential spike to ongoing fiscal challenges faced by the United States, including mounting national debt and persistent budget deficits. If Lepard's predictions materialize and a new inflationary trend becomes apparent, he anticipates a significant upward revaluation of mining shares, particularly in the gold and silver sectors. Let's get back to the interview.
The markets always tend to make the mistake of looking backwards and assuming that's what we're going to go back to. I think the world generally assumes that they're going to get inflation under control and that we're going to go back to the deflationary environment that we had for 40 years. And I completely disagree with that belief. I think we now live in an inflationary world, as Tavi's charts have so brilliantly shown. In the 70s, they had 3 waves of inflation. I think that's what's going to happen here. We went up to 9, we're back down to 3. The next run up will take us to 12. And the reason for that are the fiscal problems we spoke about earlier. And once it becomes clear to the world that that's the case, then all of these shares are going to re-rate upwards in a huge way. I mean, I fully expect to see our funds all go up 100% in the next year or two. And the reason for that is that they're just so damn cheap. I mean, I've got a lot of operating companies trading at 3 times cash flow. And, meanwhile, NVIDIA trades at an infinite number of cash flow and 40 times revenues. So, and nothing will generate, excitement in this area like good performance. And we're starting to see that as Michael has pointed out. I mean, the Newmont numbers were blowout and they were great, although their ASIC did go up a good amount. But as Tavi said, the ASIC prices are moderating, growth in ASIC prices are moderating. And so I think that there will be a re-rate in everything in this sector, including, the exploration stories, the producers, and the development stories and the producers. As we all know, there are 3 buckets. And, for people who aren't very knowledgeable in this area, in my opinion, the safest place to do is go with the producers that have cash flow. They may not offer quite as much upside as the developers and the drill stories, but they have less downside as well. I also tend to, in my portfolio, I'm really focused on silver. If this is a bull market, which I believe it is, history shows that silver is going to vastly outperform gold in terms of price movements. Now, it's more volatile, and that's the price you pay. But to me, the large silver producers, and I've got a number of them in my portfolio, they look like things of beauty that I think are going to generate cash flows that are going to shock people in the next 4 to 5 years. So, when the tide turns here and people realize that we actually are in an inflationary environment, and that based on being in an inflationary environment, metals prices are going to go much higher for many, many years, then the switch is going to be thrown, and the metals producers and developers and drill stories are all going to, provide what they have historically provided, which is, the metal would go up 10% and these other stocks would go up between 30 and 50%. You get kind of 3 to 5x leverage on the underlying metal price. And so that's why these stocks are so attractive. I mean, there are 3 ways you can make money in a mining stock. As I say, they can find more gold. So, all these trade at a multiple of the gold they have in the ground. They can produce more gold, which, generates cash flow. And then the multiple of the other two expands. And so we're at low multiples and the majors have not been finding enough gold. And so it's very clear to me that, we are the 3 of us are all sitting on names and companies and stocks that are going to be 3 to 50 baggers in a bull market for this metal. But and these ETFs are actually net selling gold, and it's just the demand out of the BRICS countries for gold to net settle, their trade imbalances that's driving the gold price higher, and the knowledge by some very savvy people that monetary debasement is absolutely cooked in the books. So, to me, I'm looking at this thing and I feel like we're kind of at that Big Short moment where the world is starting to realize that there's a housing bubble and that, these things are way overvalued. I mean, it's obviously an opposite bubble in this sense that the world is starting to look at these mining stocks and they're going to realize that, oh my God, these are going to become cash flow machines. Michael alluded to a similar thing occurring in the oil patch in 2018, 2019, and my investment partner was in that business and in that trade. And same story, they were selling at silly low multiples of cash flow, and those stocks exploded and were, multi-baggers over the next couple of years. And that's what we're looking at here. So I think that everybody who's in this area, in spite of the fact that we've all suffered, kind of constantly for a number of years, and it's felt like 2 steps forward and 1 step back, I feel like it's about to get really easy or feel easy. And that's a net positive.
Gold mining equities continue to trade well below the peak of 4 years ago, a sign of profoundly negative sentiment about the outlook for precious metals. Considering the potential for a new inflationary cycle and rising gold prices, what are your thoughts on the future of gold mining equities? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.